Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today we're going to be talking about how to prepare your portfolio for the recession. Now, the last time I did this webinar was actually on January, I think 4th or 5th, about a month and a half before the last sell-off. Now, we've obviously since then had a significant sell-off of about 33% in the markets. We've recovered most of that. And now we are actually in a recession. When I was talking about this in January, we were talking about in the context of if and when there is a recession, this is how you prepare your portfolio. Now we are actually in a recession or about to enter into a recession. We want to talk about how to prepare your portfolio as well, because we've rallied most of the sell-off back. And I think many investors feel that there are a bit of a disconnect here in the markets as far as when we might get a pullback. How we're going to get that pullback is yet to be seen, but that's exactly why we want to talk about this type of topic now, so that you are prepared, so that when you do, if and when we do get another sell-off, you know how to prepare your portfolio. And more importantly, you know what to do with your portfolio now to prepare for that eventual sell-off. So those are the things we're going to go over here today. Let's go ahead and get started. Before I do, just a quick disclaimer. What we're going to discuss here today is purely for educational purposes and not a solicitation or recommendation to buy or sell any specific securities. And for those of you that are brand new to Options Play, we're going to be showing you not only the slides, but also a platform that allows you to analyze the trades that I'll be showing you here today, so that you become self-sufficient in being able to analyze these trades on your own. So you can sign up using that a free trial for the tools that I'll be showing you here today by going to trade.optionsplay.com/join. And I just posted that link into the chat window for those of you that want to follow along. So if you have not already signed up for a free trial, it gives you access to free daily trading ideas, options education like the one you're on here right now, as well as access to a full video library so that you can look at all the other topics as far as how to learn how to trade options. So let's go ahead and get started. I'm going to start off today by talking a little bit about the current market outlook, because I think it's very important. Now, I'm not going to spend too much time going into that. I'm just going to do a brief overview. For those of you that want a more in-depth market outlook, please join me tomorrow morning at 9 a.m. where we're going to go over the current markets, the research we're looking at, and what our expectations are going forward. So we're going to look at the current market. We're going to talk a little bit about what we expect, what we see right now, what we're expecting going forward. Then we'll talk a little bit about the portfolio hedge, specifically regarding what are your options with hedging. And I want to be clear that when we talk about a portfolio hedge, you actually have multiple options. We are here to tell you briefly about what two options are, and then we're going to spend most of our time talking about what's called a portfolio hedge. So we're going to talk about how to position yourself where you remain invested in the markets, so that perhaps you still continue to capture dividends, still continue to capture an income stream, but protect yourself against a market correction. Now, some of you may not rely on dividends very heavily. For those of you that you might want to get out of the markets, those are all options. We're going to discuss what those are. Then once we understand what a portfolio hedge is and understand timing around a portfolio hedge, then we'll talk a little bit about what are the optimal portfolio hedges. And the best thing to do is really just to show you Options Play, put the two side by side so that you can compare it, so that going forward, you again become self-sufficient in being able to do this on your own. So those are the things we're going to go over here today. So we'll start off by talking a little bit about the market outlook. Now, this is something that we discuss very heavily every Tuesday and Friday morning. For those of you that do join us, I highly recommend you to do that tomorrow morning if you have not joined us here before. So as I said before, we've sold off about 35% from that February 19th high. We have rallied most of that back. We're just sitting around the 61.8 fib retracement level, which happens to coincide with the 20-week moving average. Now, that's currently still holding on the weekly chart. The daily chart looks a little bit more constructive. The daily chart, we've had multiple waves of continued rallies. This last wave certainly has weakened a little bit more. And if you look at the momentum, Every subsequent rally has continued to keep the momentum indicator sideways. These are the signs of exhaustion that we typically see. And we're going to zoom in a little bit and see, and we're going to also look at the rally from the November to February highs. We're going to look at how we're seeing many similarities right now in the last few days as we have with the rally going into the February 19th sell-off. So that's what we're currently looking at. Now, that's the broader market. What I also want to take a look at is really, we know that we're currently in a very different world than what we were in back in February, early February and January. So what we want to look at is kind of where things are different. So right now, one of the things that we've noticed is that small caps is not joining on this particular rally, right? And someone said, Vincent said something about volume. I'm going to come back to that, Vincent, but absolutely volume is something that we're looking at. But small caps sold off just as heavily, but has not bounced back nearly as much. It hasn't even reclaimed the 20-week moving average. It did reach it just very briefly, but got rejected, as you can see right here. Small caps, as far as momentum, actually looks a little bit more constructive than the S&P 500, but small caps overall still sitting right below some major support levels. Now, this is the December 2019 low. It's still trading below that. So small caps have not gotten back to where we are trading versus the S&P 500 is back near, June, July highs of last year. This is still back at the December 2018 lows. So small caps looking very different. And then on the flip side, you have technology looking extremely strong. If you look at the NASDAQ 100 or the Qs, we have basically claimed back almost 80% of the initial sell-off. That is a very different picture. So going forward, we really see a bifurcation in the markets. And when we talk about investing in a post-COVID-19 world, that's really there's really going to be a big bifurcation across have-nots and haves and have-nots in this particular world in terms of how you invest. And technology certainly, or certain areas of technology certainly will be strong in this particular sector. So if you look at Zoom Technologies, you look at even Roku, which reports earnings today, you're going to see clear winners and losers as a result of COVID-19. So we want to be careful as far as how we position ourselves in this particular sell-off. It's important to understand where there's strength, where there's weakness, and focus on where there's weakness when you're thinking about a sell-off here in the overall market. But technology certainly looks stronger. Momentum, very similar picture, is really moving sideways. As Vincent said, pretty much on all of the indices that we track, volume is actually continuing to decline on such rallies. That is the type of exhaustion that we really saw going into the February 2020 highs. And also money flow across the board on all the rallies have been very, very weak, telling us there are, again, signs of exhaustion. These are the same signs of exhaustion we saw going into February. We obviously couldn't have possibly predicted COVID. Many times we can't predict what the catalyst that actually moves the market, but we can predict that something signs of exhaustion in terms of the market. What's really difficult to do is to actually time when the correction is actually going to happen. I would argue that it's impossible to time when the correction is going to happen. And that's why it's so important to discuss timing and what to do, because you can't just go out and buy puts. It's going to be too expensive. We're going to talk about those things. We're going to talk about what can you do to prepare your portfolio now so that even if this sell-off doesn't take another month or 2 months or maybe 4 months to materialize, how do you prepare your portfolio during that time? So those are the things we're going to discuss here today. So first, let's talk a little bit about what are your options going into a recession. First and foremost, there is a strategy called a perfect hedge. Now, someone actually sent me an email about a month ago referencing this particular topic that I discussed here in January, saying thank you so much for telling me that there's this thing called a perfect hedge, because that's exactly what I did, and I was able to save my portfolio from most of that sell-off. I think I got this email back in March. I tried to find it and show you guys, but I couldn't quite find it. I just get too many emails. If you wrote me that email, please tell me here in the chat window. I'd love to discuss that. But there's a thing called a perfect hedge, meaning moving your assets into cash and then simply reinvesting it after the correction is over. So think about, if you're looking at the overall markets, as you notice that things are kind of reaching this kind of peak. Whoops. Notice that markets are reaching a bit of a peak, and thinking about reinvesting, or thinking about investing moving your assets into cash and then reinvesting it when you think that the market has bottomed. That is what we call a perfect hedge, because it doesn't cost any money other than the commissions. It is the most efficient way to hedge your portfolio because it gives you dollar for dollar hedge. You can't lose anything if your money's not in the markets. So that is what we call a perfect hedge. If you have the ability to do that, you certainly should, or certainly is one of the strategies that you should explore. Now, not everyone has the ability to take all of their assets out and remove it to cash, and maybe many of you don't want to, right? So then you have other options. You can reallocate to more defensive assets. First and foremost, fixed income comes to mind for many investors to move into a lower risk category of fixed income. Many times you're looking at treasuries or investment grade bonds. So either something like a TLT type ETF or LQD for investment grade in terms of fixed income. You can also think about defensive sectors like staples, utilities, and specifically stocks with fairly stable dividends, telecoms, those types of stocks. The only thing I want to be careful of is that typically, many times, you might find a lot of stocks that have very high dividend yields, such as energy. Energy, yields 4 or 5%, many yielding significantly higher than that. But keep in mind that when you think about dividends in a recession, the important piece is stable dividends, not just high dividends. Many times I see investors move towards high dividend paying stocks, thinking that that's going to provide protection. But many times those very high dividend stocks are the ones that are at most risk of cutting their dividends in a recession. So focus on stocks that have history of paying dividends through economic recessions. Many times banks fall into that category. Utilities, those are the types of firms that you want to think about investing your cash into. Lastly, many people put their money into gold. That certainly has been a very popular trade at the moment. Gold continues to rally. Many of the gold miners is also a leverage play, if you will, on that. That's something we actually covered on Options Action this week. So those are some of your options that you have that do not involve any options. So if you're not comfortable utilizing options in your portfolio yet, or if you're still learning, you might want to take one of these two defensive plays for your portfolio. Now, for those of you that want to trade options or want to explore utilizing options for your portfolio, that's when we can talk about a portfolio hedge, which is buying a put option to protect your portfolio. Now, I want to make sure that people are clear as far as how this works. Now, buying a put on your portfolio is something that you should only consider if you believe that there's going to be a correction that's at least 5%, typically a little bit more, like 10 to 20% or greater, for you to buy a put option. You can hedge against 5 to 10% correction, but many times this is for when you anticipate a much larger correction. And this is for those of you that own a stock or ETF portfolio and you do not wish to sell any of your holdings. Now, or perhaps most of your holdings. So I want to be very clear that this is for those of you that are invested and you want to remain invested, but you are concerned about a correction that's typically greater than 5 to 10%, okay? Now, that's what we're going to spend our time exploring here. That's what we're going to talk about, how to go about doing so with this type of strategy. So what is a portfolio hedge? The best way to think about a portfolio hedge is thinking about an insurance policy on your portfolio. Now, the thing about insurance policies on your portfolio is that it's very expensive, and we're going to talk about how that affects your decision to buy a portfolio hedge. Because when we think about insurance policies, we usually think about something that we buy all the time in case something happens. It's not quite the same for buying a put on your portfolio because it's very, very expensive. So buying a put option on a broad-based index, so could be something like SPY, SPX, any of the broad-based indices that track your portfolio. We're going to talk a little bit about that here in a second. And what's going to happen here is when you buy a put, if the market starts to correct lower, your puts will generate a profit. Now, when you generate a profit, what that's going to do is it's actually going to offset your portfolio losses. So when you buy a put option, what actually happens is that you're still going to receive a lot. You're still going to have a loss in your portfolio. It's just that you're going to have a gain in your on your put options that's going to offset a portion of your losses. Now, this creates what we call an imperfect partial hedge, meaning it's never going to hedge your portfolio dollar for dollar. You can get it close, you can get it close enough, but you're never going to experience dollar for dollar exposure. And many times you don't want to hedge your entire portfolio. You typically, most investors hedge a portion of their portfolio because again, buying puts or buying protection on your portfolio is very, very expensive. And I cannot stress enough how expensive buying portfolio hedges are. So it's something that you cannot do all the time. If you tried to buy puts all the time, you're going to cause a severe drag on your portfolio, and your portfolio is going to underperform the market severely. I would argue that if you constantly bought puts, your puts will probably cost more than the gains that you get in your underlying portfolios. So this is a strategy that requires active management and timing. And we're going to talk about some of those things here today about how to actively manage it and how to think about timing for a portfolio hedge. So just for a very quick visual representation of a portfolio hedge for those of you that are new to options trading, think of this as your portfolio. Your portfolio can either go higher if the markets go up, and it can suffer losses if the market goes down. So this is when the market goes higher, and this is when the market goes down. So as the market goes higher, you make money. As the markets go down, you lose money. Simple to understand. What you're going to add to this is a put option. A put option gives you gains when the markets go lower, and has cap losses. So if the market continues to move higher, you pay whatever you pay for the put option. That's the most you can lose. So that if the markets continue just marching on higher, like we are doing right now, that you're not taking on further losses from the put option. Now, when you combine these two together, when you combine your portfolio with the put option, what you get is a chart that looks very similar to a call option. And actually, back in the day, before put options were invented, you could actually trade a synthetic put utilizing stock and calls. And this is really how put call ratio is created. So what happens is that if the markets continue to go higher, because you've after you've bought a put, you will still participate in that overall rally because a put option has limited losses. Now, if the market was to continue moving lower, that's when the gains in your put option will be offset by the losses in your portfolio. So what that means is that if the markets continue to move lower, you will suffer, let's just say, smaller losses in your portfolio than if you didn't hedge it. So reality, the chart will probably look something like this rather than a straight line, because a straight line infers that you have received a perfect hedge. As we said, that buying a put option is an imperfect hedge. So what you get is a line that's significantly better than if you kept it unhedged, but it is still going to generally have some losses if the market continues to move lower and lower. Okay, so that's the basis of a portfolio hedge. Now, let's talk a little bit about timing. Now, before I jump into the timing, I want to ask a quick question here. So I have a poll here on the screen. Where do you see markets in 1 month? Higher, lower, or if you're not sure, please answer this poll here. I just want to get a sense for the room here. Okay, so good portion of you have voted now. About 50% of you say lower. Only 16% of you say higher. And 32% of you say you're not sure. Okay, great. I think that is a great answer. Okay, so 49%, basically half of you are pretty confident that the market's going to be lower. 33% of you say you're not sure. And I think many people fall into this category of basically saying, I think the markets should be lower, but every single day I look at the markets keep going higher. It's not going any lower. No matter what type of economic numbers come out, no matter how bad things look, markets keep staying sideways or moving a little higher. And then 18% of you say you think it's going to move higher, similar to kind of what we saw back in January and February. Even though we kind of all felt that a correction was on the road, that it was coming up, the markets just kept grinding higher, and that's exactly what we're seeing. So I think that the what you guys are expressing here in the markets reflects what many of us feel. Okay, so first I'm going to talk a little bit about timing. Okay, so because timing is really important, not only for the correction itself, but I think more important, leading up to the correction. You know, at this point right now, where there's a pretty big, I would say, disparity as far as how we view the current markets. Right now, one of the things is that prior to a sell-off, what we typically see is that markets will generally stall, or at least there will be signs of exhaustion in the markets. And if we look back to what we saw back in from the November breakout, so you know the markets traded in a very range bound market between April and November of last year, and then in late October, early November, the market started to break out. And as it broke out, it really provided very few pullbacks, but just continue to grind higher. You know, pushing us to all-time highs, pushing us to all-time highs, pushing up to peak valuations, historically speaking, at least since the 2008 financial crisis. And you know, during a time where economic activity wasn't looking particularly strong, or certainly wasn't growing at that type of pace, which is why many people thought that the markets were getting a little ahead of itself and a correction was coming. But we certainly could not anticipate that the COVID-19 was going to hit. And this is what I'm going to call a not bullish phase. And I want to be very clear, because I want to make sure that there's a distinction between saying that I'm not bullish versus saying that I'm bearish. Okay, so I would say more than, you know, the 33% of you that said you are not sure, this is probably the best way to sum up what you currently feel the markets are. You're not bullish, you're not bearish. I'm sorry, you're not bearish, but you're certainly not bullish. And I want to make sure that everyone understands the clear distinction between those two things, because when the markets are not bullish, this is where the markets can continue to grind higher, but you don't think that the markets can go significantly higher from here. It's very important that when you feel this way, which many of us feel right now, what you want to do is you want to make sure that you utilize strategies like selling cover calls on the stocks that you own, selling call credit spreads, because what you want to do is you want to take this time to collect premium, because buying put options are really expensive. How can you pay for those puts? You have to collect premium when you're no longer bullish on the markets, because markets can stay in this not bullish phase for months at a time, as we saw from many times. I would say beginning of January of 2020 is when we started to feel that the markets were no longer bullish. You know, corporate earnings were no longer growing as we were expecting. Corporate profits were no longer growing. So we were in this phase of not being bullish. That's when you want to start selling cover calls. Take profit on your stock positions by selling cover calls. Sell call credit spreads to collect some premium, because you're going to need that premium if and when the markets do correct. That actually took 3 months for that to happen, right? From January to basically, I'm sorry, from November to February. And then once we had that sell-off, it was a major sell-off. Buying put options during that sell-off would have been very expensive. But what you want to do is you want to start preparing for that now. I want to make sure everyone understands this. If this makes sense to you, please type 1 into the chat window, that when you feel that the markets are no longer bullish, this is the time to start collecting premium, because you're going to need that for trading. So just to look at the markets right now, right? So I'm going to use the weekly chart here for something's wrong here. I don't know what's wrong. Something does not look right with this chart. I'm gonna have to figure out what's wrong here, but something, this moving average here does not look correct. So I'm gonna actually, I don't know what's going on here. All right. So we have a weekly chart here on the left-hand side. We have a daily chart here on the right-hand side. So what we see is that one of the things I want to point back to is that during the November to January rally, as the markets continue to move higher, we saw momentum actually continue to not make any higher highs. Momentum actually started to make lower highs. These were the signs of exhaustion that we saw in the markets leading up to that leading up to the February 19th peak. Now, again, what that doesn't provide us with is an indication as to when things are going to turn around. It just tells us that things are not really okay. This is quote unquote not bullish phase that we anticipated in the early in the late stages of that rally. Now we're starting to see some of that again in the current market rally. As markets continue to move higher, we are not seeing momentum continue to move higher. It is actually continuing to move a little lower. So these are the signs of exhaustion that we are currently seeing. Now, again, this exhaustion can continue to go on for quite some time, right? This is not to say that the markets are going to drop. As far as how long will this market continue to grind higher, there's nothing that we can necessarily look at to tell us that the markets are going to start correcting. So it's important that just while we're in this not bullish phase, that we take a look at utilizing strategies like selling call credit spreads, selling put credit spreads, because in this type of market, you have a very range-bound market. And what you can do is if you look at an hourly chart, you'll see that you can utilize momentum indicators like RSI. These are perfect conditions to sell credit spreads. For those of you that want to take a look at my webinar on credit spreads, this is the best time to utilize this type of strategy, because it's important that you think about how to utilize these charts, utilize these types of technical indicators to give you a sense for when things are not looking okay. You know, same thing. The other thing also is just that as markets continue to move higher, money flow actually continue to look significantly weaker on further rallies. Money flow momentum did not confirm these new highs, and that was really our indication that it's time to sell credit spreads. It's time to sell cover calls, start taking profits on your trades, and then start looking at getting out of these particular strategies. And we're looking at the same type of market right now. So it's important to think about it's in my opinion, most important to actually think about what to do now, because when things will turn very quickly. So how do we know when things are going to turn? How do we know when markets are going to start correcting lower? That's where we can look at certain timing indicators. So the entry for a portfolio hedge should be utilizing certain types of volatility indicators. So one of the ones that we looked at during this current correction is the VIX, and we will look at VIX contango. We look at when front month versus later month VIX inverts. So when the front month VIX, many times what we do is we measure the 3-month VIX versus VIX ratio. When it falls below 1, that's usually a good indication that risk is off. And then when it goes back above 1, that's when risk is back on. And we'll talk a little bit about exiting a hedge, but let's first talk about entering a hedge. Now, as you can see, this actually triggered when the VIX 3-month when the VIX fell below, when the VIX 3-month fell below the VIX. So when the later month VIX when the VIX was greater than the 3-month VIX. I know some of these ratios sometimes gets confusing. This actually triggered on February 21st, which is just 2 days after the peak of the S&P 500. So it was a very quick indication of when things started to turn around. So, and you can use operators like this to look at it. I'll pull up a line chart just to show you. Look at a daily chart. As you can see here, the VIX 3-month fell below the VIX 1-month on February 21st. That's just 2 days after the peak of the overall market. So it's a very quick indicator of telling us when things are starting to turn lower. And you can actually scroll back here. Many times throughout the year, it did peak below it, but it moved right back above. The last time I really spent any significant time below it was December 2018. So this is an indicator that you can take a look at to say, you know, if things start to accelerate to the downside, I would keep an eye out on the VIX versus the VIX 3-month, because once this turns negative, that's usually a very fast indicator of things are starting to turn around. Might be time to pull the trigger on buying a put option for your portfolio. So again, don't go out there and buy puts right now, because many times, there were a lot of investors during the January to February rally. I certainly got a lot of questions from users asking. Let's see. Okay. There were a lot of investors that emailed us saying, especially during these times, as saying VIX is really low, buying protection is really cheap. Should I go and buy protection? Yes, protection is really cheap, but cheap protection doesn't really do you much good if the markets don't correct, no matter how cheap it is. A put option is still going to be worthless at expiration, no matter how cheap it is. So keep that in mind. Don't go out and buy puts in anticipation of correction, because chances are you're going to lose a lot of money most of the time, and then only once in a while will you be right. But most of the time that you're wrong will offset any of the gains that you have here. So it's really important that you don't go out and buy puts just because puts are cheap, or just because you think that maybe things might turn around soon, because things can certainly grind higher for significantly longer than you can continue to pay for put options. So what's important is that now you collect premium. When things are not bullish anymore, start collecting premium. That process can last weeks or months before the markets start to turn around. Once the market starts to turn around, using VIX, and you can use VIX as your indicator, then you want to start buying puts. Puts will be more expensive, but you're not buying puts unnecessarily. Does that make sense? Please type 2 into the chat window if that makes sense to you. Okay, perfect. Lastly, now we'd want to talk about the exit. When do you want to exit a hedge? So one of the things that a lot of quantitative analysts look at is the fact that volatility peaks usually a few days before the market actually bottoms. Okay, so if you look at the VIX peaked. I'll show you a chart here. The market bottomed, I believe, on March 23rd. The VIX actually peaked here on March, I think it was the 17th or so. So quite a few days before the actual market bottom, the VIX peaked. So what you generally will see is near a market bottom is that as the market continues to move lower, the VIX also moves lower along with it. When you see that, when you start to see that, that's usually a good indication that we are near a market bottom. This is what we call volatile. So the volatility of volatility starts to fall before the market bottom. And that's usually a good sign of a market bottom. So many times we look at days when you have multiple days in a row where the market continues to move lower while VIX also moves lower. That is a good sign that we are near a bottom, and that might be a time to start unwinding your hedges. So if you bought a put option, start taking profits on those put options when you see multiple days of market declines with volatility declining. So I'll just show you a chart of that as well. So this is the VIX. We'll use a line chart to make it a little easier to see, and we'll compare it to the S&P 500. As you can see here, the VIX peaked here on March 16th. The VIX peaked on March 16th. The market bottomed on the 23rd. So you have a full 7 days, 7 calendar days, or 5 trading days where the market continued to move lower, but VIX moved down from roughly, I don't have levels here because I'm using percentages, but the VIX at that point fell, I think, almost 30 points from the peak as the markets continue to move lower. So that's usually a good indication for when you might want to exit your hedge. So those are the 3 most important timing things to think about when you're thinking about putting on a hedge for your portfolio. In my opinion, that is more important than what actually hedge you put on, which we will talk about here as well. So we're now that we've discussed the timing, now let's talk a little bit about how do you put on a hedge. So first of all, we have to pick a hedging instrument. Now, this is really where for most users that have a well-diversified portfolio, you want to pick something that's highly correlated to your portfolio. So if you have a well-diversified portfolio, you would likely use something like SPY or an S&P 500 index, or something that's very highly correlated to the S&P 500 index. Some of you might have more of a tech-focused portfolio, which many of you do. You tend to find that your portfolio consists of mostly the big tech names. Then you want to focus more on perhaps a tech-focused index, such as the NASDAQ 100. And then some of you may have very concentrated positions in a particular sector. Some of you may have worked in a particular company for a long time and acquired a lot of stock in that particular company. And perhaps you have a lot of exposure to a specific sector because you work in that sector and you know that sector, so you buy a lot of stocks in that particular sector. Then you might want to be more focused using a sector ETF. But the goal is to pick a index that closely matches your portfolio. Now, if you don't have a tool that your brokerage firm provides, and most brokers do provide something like this, Morningstar has a thing called a portfolio X-ray. This gives you an idea as far as what your portfolios consist of, so that you can get a sense for where you have the most exposure. So for example, if you have mostly large cap stocks, as you can see in this particular portfolio, mine is predominantly large cap stocks, and it's across value and growth. I would use something like an S&P 500 or maybe even a NASDAQ 100, which consists of almost entirely large cap stocks across the spectrum of core value and growth. So you generally want to use some kind of portfolio tool like this to get a sense for what does your portfolio consist of, what sectors you have a focus on, and then picking an index that closely matches that. And then what you want to do is you want to start thinking about expiration dates, okay? So most of these corrections tend to be fairly quick and violent, especially in our current new volatility regime, is that we have longer and longer periods of these, what I would say, VIX compression periods, followed by very, very large explosions in volatility that tend to be very quick and very violent. So in that particular environment, generally speaking, you may not be holding onto a hedge for that long, actually. If you think about this particular sell-off, this 35% sell-off, it lasted pretty much just a single month. Now, the thing about buying options or put options on your portfolio is that what's really working against you is time decay. Time decay is the biggest thing that is going to offset the gains of your put option. So how can you optimize your hedging by picking the right expiration date? And the answer to that is simply using longer dated options. So generally speaking, longer than 2 months is a good time frame to start, because what you're trying to do is you're trying to minimize your time decay. Can you buy a 1 month option and simply hold it onto for a whole month? You absolutely can. But during that 1 month, you're going to experience a fair amount of time decay, as opposed to if you want to hold on to it for a month and you bought, let's say, a 3 month option. What you're going to notice is that during that 1 month, you're going to decay less. So in this particular case, you lost maybe this much, versus if you traded a short-term option, you might have lost twice as much or 3 times as much. So it's really important that when you're buying an option, you buy a longer dated option, even if you only plan on holding it for 3-4 weeks. Then if you buy that 3 month option, only hold it for 3-4 weeks, the time decay you experience during that time is going to be significantly less than if you bought a 1 month option. So I want to make sure everyone understands that. So please type 4 into the chat window if that makes sense, that when you're buying a hedge, you want to buy longer dated, even if you hold on to the trade for a shorter amount of time. So expiration date selection, very important. Now let's talk a little bit about strike prices. This is really where it depends on how much protection do you want to buy. Think about an insurance policy. Think about your health insurance. You can buy different levels of protection, right? You can buy catastrophic insurance that protects you in case of a large catastrophic event, or you can buy very comprehensive insurance that covers you for pretty much everything. And just like insurance, catastrophic insurance is cheap, comprehensive insurance is expensive. Now, many times I tend to find that most investors gravitate towards buying catastrophic insurance, and mostly because it's cheap. Most people do not want to spend a lot of money buying those put options. They're thinking, well, if the market makes a big move, Those out of the money options will give me a better rate of return on that particular move. So I'm going to buy those cheap options. They cost less, but many times cheap doesn't provide you with much coverage. And I'm going to show you why. So cheap options are what we typically call out of the money options. So usually about a 30 to 40 delta is a good starting point. And then you can buy comprehensive insurance. These are in the money options, usually about a 50 to 60 delta option. So slightly in the money, not too far in the money. These will cost usually anywhere from 3 to 5% of your portfolio value. Now, this is all looking at roughly 2 months out. This is the type of insurance that you would be buying in your portfolio. So I'm going to show you both. I'm going to show you why when I hedge my portfolio, I prefer using something like a more comprehensive insurance, even though it's more expensive. I will show you why in most scenarios, this will give you the better outcome between the two. So that's a quick review of how do you think about your portfolio hedge? How do you think about timing your portfolio? And then once you've decided that you're ready to pull the trigger on a timing portfolio, now we'll show you how to actually analyze a particular trade. And for that, we're gonna go to options play. So this is a tool that everyone has access to either by a free trial or if you're a member. And what I'm going to do is I'm going to show you how I'm going to set up options play to analyze a comprehensive hedge and a catastrophic hedge. So I'm going to start with 100 shares of SPY. I'm going to use that as a proxy for my portfolio. And then you can use any ETF. So if you have a NASDAQ 100 index, you can use the Qs. If you have if you have, let's say, a financial focused portfolio, you can use XLF. Find an index that closely mimics your portfolio. And then what you want to do is you always want to have 100 shares, a long 100 shares to mimic your current portfolio. And what we're going to do is we're going to modify these two other strategies to be a long put. So what I'm going to do here is I'm going to look at a long put. I'm going to go out roughly, let's go out to July, which is 71 days. So a little bit more than 2 months. And what I'm going to do is I'm going to look at maybe let's say a 292 strike, which is a few dollars in the money. And then what I'm going to look at is a same thing, a July. And I'm going to go out to, let's say maybe a let's do a 280. Let's see, 287. Let's go a little higher. Let's go 297 and let's go 277. So one is $10 in the money, one is $10 out of the money. So this represents my comprehensive insurance. This represents my catastrophic insurance. Now, to make this a little bit more real, what we're going to do is we're going to use our risk and investment calculator. We're going to type in how large your actual portfolio is. So let's just say, for example, I have a $250,000 portfolio. And what this does is it automatically calculates the number of shares to mimic a $250,000 portfolio. And then it also at the same time calculates how many contracts I need to purchase to hedge my $250,000 portfolio. So here, the comprehensive insurance costs $17,000. The catastrophic insurance costs only $10,000 on my $250,000 portfolio. So $10,000 divided by $250,000 portfolio is roughly 4%, right? So we said it was in the 3 to 5% range for the, well, things are a little bit more expensive right now because VIX is still trading at 30 vol versus back in February, VIX was trading at 10 or 11 vol. So 4% for the catastrophic insurance. The comprehensive insurance is roughly 17.5. Divided by my $250,000 portfolio is 7% of my portfolio. So the cheap insurance cost me 4%, the expensive one cost me 7%. So think about it, 7% of your portfolio gone in 2 months if the markets don't correct any lower. That is a fair amount of premium to be paying. And that's why buying put options are so expensive. And that's why you shouldn't just willy-nilly go out there and buy insurance hoping that the markets are going to correct, because if you do, you've lost 7% of your portfolio in just 2 months. So that's why it's so important that in this particular time, you collect premium on your portfolio by selling cover calls. Right now, with volatility relatively high, you're actually going to get a fair amount of premium, but you might end up collecting premium for a couple of months before the market's correct. So you might be able to pick up a few $1,000s in premium. You might not be able to collect $17,000 in premium, but you certainly would be able to collect a fair amount of premium, at least maybe somewhere in the $5,000 to $7,000 range. That's going to significantly reduce the cost of buying these put options when you do need them. So let's take a look at these strategies. I'm going to use the P&L simulator here. So the first thing I'm going to simulate is what happens if, let's say, a month from now, the markets still stay where it is, meaning we grind a little higher, we grind a little lower, and the market stays around this 290 area. Let's say that happens, and let's say we're talking about mid-June, the markets are kind of maybe moving a little lower, and I'm sorry, the markets are staying where it is, and we haven't really moved anywhere. So first off, this is really where, in my opinion, the comprehensive insurance, which is more expensive, even though it's more expensive, is far better. And it really comes down, it all comes down to time decay, because when you buy this out of the money option, it's all time value, it's all time decay. It's going to decay fairly rapidly. So as you can see here, as the markets continue to move lower here, as the market stays where it is, what's going to happen is, let's say a month from now, right now it's March 7th, let's say by June 7th, the market is still where it is. As you can see here, the market here in this particular case, I would have gotten, it's still pretty much flat here in my overall portfolio. But my comprehensive insurance, which cost me 7% of my portfolio, would lose about $3,700 worth of value. So that's the time decay that I would experience in 1 month out of the $17,000 that I pay is about $3,700 in time value. On the catastrophic insurance, because it's all time value, I'm losing $5,300. And this is really where, in my opinion, it's really, even though you're buying cheap insurance, it's going to evaporate at a much faster rate if the expected move that you want to see, it does not materialize, or if maybe the markets start to move lower and then just starts to move back very quickly, and you don't get out fast enough. So this is really where the catastrophic insurance, in my opinion, does not play out very well. Now, if the markets move a little bit lower, let's say it moves down to 270 or so. If the markets move down to 270, here I've lost $15,000 in my portfolio. Not a small loss, but if I bought these put options, these comprehensive insurance, I'd make $9,100 back. So instead of losing $15,000 and I make $9,000 back, I'm down roughly $6,000 here on this particular trade by buying the more comprehensive insurance. Here, I'm only making $2,600. So even though that the markets have corrected down to 270, it's a small correction, not a major one. But here I've lost $15,000 in my portfolio, and I've only made $2,600 back on my catastrophic insurance. So if the markets move a little lower and doesn't accelerate to the downside with a strong force, I'm really significantly worse off with the catastrophic insurance. Now, if the markets start to continuing to move lower, let's say it revisits the 243 level, which was a major support level that we've been talking about in our market outlook sessions. Here, now I've lost $38,000 in my portfolio. So now I'm talking about a significant hit to my portfolio in my stock portfolio. The catastrophic insurance, the comprehensive insurance would make $31,000 on that particular trade. And that would offset the $38,000. So I'm down about $7,000 or so in my portfolio instead of being down $38,000. The catastrophic insurance would make $21,000 back. So between the two, the 38 and the 21, I'm still down on another $17,000. So I'm certainly significantly better off than if I didn't hedge it, but I've only hedged about half my risk, even in a fairly severe sell-off here down to 240. Now, if the markets continue to move lower, you'll see that pretty much at this point, I won't lose much more than $10,000 with my catastrophic insurance. Even the market goes to zero, I'm only capped at roughly about $10,000 worth of losses here. I'm sorry, about $6,000 worth of losses here. So as you can see, $51,000 loss in my portfolio, I make 44 of that back with my comprehensive insurance. Here I lose 51, I make 33 back. So roughly here about 17. So the difference between these two is the fact that I can lose roughly no more than about $6,000 here in this particular scenario. And in this particular scenario, I'm losing roughly 14,000. No, 17,000, 17 to 18,000, somewhere in that range. So that's really where the difference between the extra $7,000 that I paid here will actually deliver me, in this particular case, an extra $12,000 in savings in my portfolio. So this is really where the catastrophic insurance provides you with much better coverage than the catastrophic insurance. Now that's to be expected, right? Because I am paying more. I'm expecting to get better protection. But really, in my opinion, the best thing about the catastrophic insurance is the fact that even the markets don't move very much, many times you will still get some coverage. Many times the catastrophic insurance, let's say the market moves down to 270, meaning it doesn't move very much, what you actually end up with is still a loss on the catastrophic insurance. So imagine buying protection, the markets move down to 270, and you've lost more money than if you didn't buy protection. That is in my opinion, a painful experience to have, is to buy insurance, the markets move lower, and then lose more money than you originally started with if you didn't buy a hedge. And that's why, in my opinion, I think it makes the most sense many times to buy the more expensive option, especially if you're timing this correctly, meaning you're not just buying protection hoping that the markets are going to correct, that you only buy protection when the markets start to correct using the timing indicators that we talked about here earlier. Now, these timing indicators, we are keeping an eye on this. So for those of you that are joining us on Tuesday and Friday mornings, we've been talking about the VIX going into contango, going back into backwardation, and looking at the two and seeing when we're in this risk on, risk off environment. I will say the market has kind of flip-flopped a lot over the last few weeks, but right now the VIX is very much in this risk on mode. But the signs of exhaustion that we're currently seeing puts us in this risk on but no longer bullish phase, because momentum is starting to we're seeing negative divergence on the momentum. Money flow remains to be very weak on these subsequent rallies. Volume continues to decline on each subsequent rally. So these are all signs that markets are starting to show signs of exhaustion. Small caps, same thing. So we're seeing this across the board, but again, that doesn't mean that the markets are going to correct now. So when we're in this current phase right now, the best thing to do is to make sure that we think about collecting premiums, selling cover calls, selling cash secured puts. Sorry, not cash secured puts. I don't think you want to do that right now. You want to sell credit spreads right now. Collect that premium, because if and when it comes to buying that protection, you might end up paying 10% of your underlying portfolio to buy a put option. Hopefully at that point, you've already collected 4-5% of premium in order to do so that you're actually only net paying about 5% of your portfolio to buy this protection. But that's the rule, is that you want to do that now so that you don't have to wait, so that when the markets start correcting, you have some premium in order to do that. So that's what I wanted to show you here today. It's really important that you utilize a symbol that mimics your portfolio. So make sure that you select one that closely matches your portfolio. So for those of you with tech portfolios, to utilize an ETF like the Qs instead of SPY, or XLU, XLF, whatever sector ETF, perhaps if you have a sector focused portfolio. This really allows you to get the best possible protection on your portfolio as the markets correct. And just a quick review before we wrap this up and start answering questions is make sure that you always have the stock portfolio on the left-hand side. You can set up 2 put options by using our strategy constructor, selecting put options. And again, make sure that you always start off with an expiration that's roughly 2 months out as a starting point, perhaps going out a little longer if you do have, SPY obviously has far more expirations than some of the other ETFs, but I would start with a minimum of July in this particular case, which goes out 71 days. And then you can also construct different strike prices. You can say, well, what happens if I buy this 215 versus maybe a 227, something that's roughly $6-7 out of the money, or $6-7 in the money, and compare the two. And the best way to do this is first enter your portfolio size. So if let's say you have a $70,000 portfolio, enter that so that you mimic a $70,000 portfolio. And it also calculates the appropriate number of contracts for you so that you are comparing something that's actually comparable for your portfolio. This allows you to then see what happens if the market moves lower by a specific date. You can even make volatility assumptions because we know that as markets sell off, volatility increases. You can make some of these adjustments and see how much protection are you actually getting from the catastrophic insurance, how much protection are you getting from the comprehensive insurance, and then making a decision on your own. You might even want to select, an at the money option instead of any of these options. So this is really where you can utilize options play to your full advantage and learn how to be self-sufficient in being able to analyze one of these hedges for yourself, because markets can continue to move higher for another week, another month. We really simply do not know. But when the markets do correct, things are likely going to move very quickly. So it's important that we know how to utilize our tools to be able to analyze the trade on our own. So that's the important part that I wanted to go over with you here today. So thank you so much for taking the time out here this afternoon. I really hope that you guys are able to take something away from this for your portfolio. And just a quick wrap up before we open this up for Q&A. Constant hedging is not cost efficient. So don't try to go out there and buy protection all the time. You're much better off being late than early. You only want to hedge when you're bearish. When you're not bullish, what you want to do is you want to make sure you sell covered calls, you sell credit spreads, and you collect premium that's going to help you offset the cost of buying puts if and when the markets start to correct. You always want to generally look at in the money puts because they provide better overall protection. But for those of you that only want catastrophic insurance, you want to buy those out of the money puts. So that's a quick review of what we went over here today. I hope that you guys find this useful for your own portfolio, especially going into this, what I would say, challenging time to trade these markets. And also for those of you that want to keep on top of where we actually are in that cycle, please join us on Tuesday and Friday mornings. We do that every single week. I'll post the link to how to join for those of you that have not signed up for that. I'll just post the link into the chat window if you want to sign up for our Tuesday and Friday morning session. And before I open this up for Q&A, I just want to remind everyone to allow us to continue doing this every single Thursday and providing this type of research and education for you guys. Please consider supporting us by becoming a member by going to this link on your screen. And I just posted that into the chat window. Membership is just $75 a month or $500 a year. And it gives you access to everything: the platform, the daily trade ideas, the weekly education, the weekly market outlook sessions, and all the different reports that we've been building that are now going to be incorporated into options play to show you how to access different platforms to show you, things like liquidity that are really important. This is something that we highlight a lot in our morning outlook sessions, to look at how many symbols are liquid. For those of you that are figuring out what symbols to trading the liquid symbols are very, very important. Also, earnings calendar. We have passed the bulk of the large cap companies, but you still have a lot of smaller cap companies coming up. You have Home Depot, you have Costco, you have a lot of big names that are still coming up here. So important to know what earnings are coming up. More importantly, what earnings are coming up that are liquid from an options perspective. We only try to trade the ones that are very liquid. So this is all available to you as a member here for Options Play. So again, I want to thank everyone for taking the time out here this afternoon. Thank you for supporting us and allowing us to continue doing this and providing this type of research and education for you guys. So with that, what I'm going to do is I'm going to turn this over for Q&A. What I'm going to ask is that if you have a question, please type them into the Q&A window. There's a chat window and there's a Q&A window. Please type your questions into the Q&A window and I will answer your question there. So thank you so much. And let's go take a look at the questions here. So do you have plans to show all of the active daily trade alerts in the website? So you have all of them here in the portfolio tool. So you have all access to all of our open positions here in the portfolio tool. So that's available to you right there. When you talk about when you talk so much about liquidity, why are your ideas and options play so heavily skewed to small caps? I think, I mean, as far as the ideas that we send out, they're always large cap names. We almost never provide any type of small cap ideas. If you're talking about the trade ideas, you can actually filter based on caps. So, I mean, at the end of the day, this platform is not just for options traders. We have a lot of stock traders that utilize our ideas. So we can use this for both stock trading and options trading. The reality is that there aren't that many large cap names, so if you look at the very liquid names, out of 8,000 symbols that you can trade, only 153 of them are what we consider very liquid. This is something that I think many options investors don't recognize, is the fact that there's 4,200 names that you can trade options on. 4,100 of them aren't very liquid. That's the reality of options trading. I'll be honest, I'm not sure why we list options on 4,200 names when I wouldn't touch roughly 4,000 of them in my trading. But we list them, but we want to show you which ones you actually should focus on, which is based on this liquidity list. Is the tech rally losing stream and will rotation occur soon? So I'm not a big believer that the tech rally is necessarily coming to an end, because I do think that the post-COVID-19 world is going to look vastly different. And I do think that technology is going to be one of those sectors that will continue to see strength after the COVID-19, and certainly will be more resilient than many other industries, such as consumer discretionary, that I think are going to have a tough time after, as we enter a recession. I think between automation, between working from home, between security, these are all things that are going to boost specific industries within tech. I think tech itself is a little too broad, but I think there are very specific pockets of tech that will continue to do very well post COVID-19. So those are some of the things that we discuss on our Tuesday and Friday morning sessions. Why do you look at the 20-week moving average rather than 50-day or 200-day? I look at all of them, to be perfectly honest, but I generally tend to focus more on the 20 and the 200 for the most part. So fairly short term and fairly long term. What do you think about the cruise lines and airlines? Do you think that cruise lines and airlines will still fall? I certainly think that the more we look at this, the more I think that travel is not going to pick up anytime soon. I think at the earliest you're looking at 2021 for international travel. That's at the earliest. I think that can continue to get pushed out. As long as globally we don't have a unified response to this, air travel is going to be extremely limited, especially in international air travel. So I think that I would not touch the airlines or cruise lines just yet. How far your expiration dates shall be. I think we covered that already. A quick reminder of how to sell credit spreads would be good. So for those of you that want to learn how to sell credit spreads, I am going to be covering that, I think, in a couple of weeks. That's going to be the education topic that we're going to be doing. When you get the recording for tonight's webinar, we're going to send you a link on how to sign up for the next one. But if you look at our YouTube channel, we have one called Maximizing Income with Credit Vertical Spreads. I recommend that you take a look at that, and I'll post that into the chat window for those of you that are interested in watching that. But that's a great reminder of how to sell credit spreads. Can you talk about cash secured puts, sell to open strategies? I also talk about that very heavily in my generate an income stream for your equity portfolio. So that's all available using the link that I just sent you. So I do talk about cash secured puts very heavily there. Why on a vertical put credit spread does increasing the spread by putting the out of the money strike further out of the money reduce the risk? Michael, I'm not sure I understand your question there about put credit spreads. If you don't mind rephrasing that or give me an example, I'm happy to answer that. Can you give me a good example of collecting premium with a $100,000 portfolio, and how much should I expect to collect? So, I mean, look at like SPY, right? So if just looking at an SPY contract, or maybe I should have just used the Qs. SPY is a very large chain, so I'm going to wait for that to load. While I wait for that to load, Alan, I'm going to answer the next question. Can you explain a call credit spread? Yeah, so again, for those of you that don't know what a credit spread is, I highly recommend you to watch my video on credit spreads. That's going to help you better understand that, because it's a little too much for me to just explain here in a few seconds. But let's first look at, so I'm going to look at income for SPY. I'm going to collect roughly here. Well, let's do this. How many shares of SPY is a $100,000 portfolio? It is 346 shares. Okay, so do I own SPY? I own 346 shares. So this is going to collect me roughly $500 every 22 days on SPY. That gives you a sense for how much you can collect. Now, this is for SPY. That's 0.5% of the underlying stock in 22 days. I would argue that you probably don't own $100,000 of SPY. You probably own some individual stocks. So let's say you own stocks like Apple in your portfolio. You're going to be able to generate significantly higher yield on individual names. Let's see. Roughly 350 shares as well there. So here you're earning about, Apple, very, very little yield too as well, $507 here. So you're going to have to look at what stocks you own and how much yield you can expect. But generally speaking, in this particular market environment, we're seeing most stocks are generating close to 1% every 3 weeks or so. So that just gives you a ballpark number of what you can expect on a credit spread, on a cover call. Now, a cover call is going to generate a little bit more yield for you than a call credit spread. What are your chart settings for TradingView? If you don't mind, send me an email at info@optionsplay.com. I'm happy to answer that. Just a little too much for me to say it out loud. There's just too many settings. Would credit spreads be better than iron condors or straddles if we're temporarily range bound? So an iron condor is really just half of a credit spread. So I would say they're very similar. I like to sell credit spreads because markets don't just stay stable. Markets kind of whipsaw back and forth, right? So when they kind of whipsaw back and forth, I like to sell a put credit spread here, a call credit spread there, a put credit spread there, and a call credit spread there. Trading an iron condor, is more of a short volatility strategy rather than just a pure directional strategy. So, that's why I prefer credit spreads versus iron condors. Now heading into May, go away is another downer pressure. So, the old adage of sell in May and go away certainly has statistical merit to it. But the one thing I will say, we are in an election year, and generally speaking, in election years, that seasonality indicator does not hold up as well. So be careful about that. But certainly there is something to sell in May and go away. Is that called VVIX, derivative of the VIX? I'm VVIX. Let's see, VVIX peaked on March 16th, started to move lower. I'm not sure what VVIX is, I'll be perfectly honest, but this looks like VIX, but the numbers are not the same. I'm not exactly sure, but I know there is a volatility indicator. But that certainly did look like the right chart, because this peaked on March 16th, started to move lower, significantly lower. And basically when you see that a chart like this moving lower while the equity markets continue to move lower, again, that is a good indicator of that you are near a market bottom. Why not a collar strategy? You absolutely can do a collar strategy, and that's sort of what I'm implying, is that you want to sell cover calls now to buy put options. Now, the reason that you don't want to do a collar strategy is that a collar strategy is still going to cost you money. Why buy puts when you don't need to buy puts? You could have collared yourself. So let's just go back here. You could have collared yourself. You could have put on a collar this whole rally up, but you would have spent money buying puts that you simply did not need. And that would have still cost you money to put on a collar. You can put on a zero cost collar, but you're really giving up most of your gains to the upside without getting much protection to the downside. You're better off selling cover calls, throughout this. As the markets continue to move higher, that allows you to take profit on your stocks. And then once you see that the thing starts to move lower, which happened, for our indicator, that happened on February 21st, which was right here. That's when VIX turned lower. You would have bought puts maybe here on this day, and then you would have been able to hedge yourself most of this move to the downside by buying put options. So it's not that you can't use a collar, it's just not as efficient. The insurance scenarios really shows well the impact of higher delta versus lower delta as undervaluing. Thank you, Chris. I appreciate that. Buy the catastrophic also costs $7,000 less. And I showed you, well, yes, you get $7,000 less, but significantly smaller hedge on your portfolio. Cheap does not mean good, right? I mean, when you're buying protection, think about buying insurance. Yes, you can buy the cheapest insurance, but may not provide you the coverage that you want. Correction increases pop, but not reduce risk. I'm not sure if that's a question, Michael, if you don't mind clarifying. You need to use the net benefit versus cost. Yeah, exactly. You want to look at not just the cost, right? If you just look at cost, that's not the right way to think about options, because if you just look at cost, then you should always buy out of the money options. But guess what? That's a losing proposition in the long run. How do you put stops on stock positions compared to buying protective puts? How do you put stops on stock positions? Well, you put a stop on a stock position by placing a stop order versus buying protective puts. I'm not sure I understand your question, Tyler, if you don't mind clarifying. Would a hedge at 287 be in between the two scenarios? Raj, that's a great point. You can utilize options play to see, buying an at the money option. There's nothing wrong with buying an at the money option. Actually, the more I look at it, the more I prefer buying an in the money option that's just slightly in the money. I made the two comparison to show you the difference between the two. But when it really comes down to trading, I tend to find that I prefer buying just slightly in the money options. If the market goes up, what happens to the call credit spread? So you would lose money on the call credit spread if the market rallies significantly. So again, you don't want to do this if you think the markets are still going to rally significantly. You only want to do this when you start to see those signs of exhaustion. So the past few weeks, the markets have made zero progress. We were at 287 2.5 weeks ago. This is the time to sell call credit spreads, because you don't think the markets are going to go to 310, 315. If you think the markets are still going to go to 310, 315, you should not sell call credit spreads, to be clear. What is a risk on, risk off when VIX 3-month versus VIX falls below 1? That's your risk off indicator. When it's back above 1, that's your risk on indicator. But again, risk on, many times I tend to find that the VIX is too late. You want to look at the VIX peak. When the VIX peak coincides with the markets continue to move lower, as we were showing you before, VIX started moving down about 30 handles while the markets still continue to move lower. That's a better risk on indicator, in my opinion. How can you take advantage of changes in volatility? That is a question outside of what we're talking about here. But if you want to trade volatility, the best thing to do is trade butterflies or straddles. If you have the ability to trade naked straddles, buying long straddles when you think volatility is going to go higher, and selling short straddles when you think volatility is going to go lower. That's the only pure volatility play. Could you draw the VIX indicator on top of your stock chart in options play? So that's not something we currently offer, but we are looking at integrating TradingView into our platform. So that is something that we are hoping to have very soon. Why does the options play score for each trade not change when the sliders are changing? Because the options play score is based on the premium that you're paying for that. The premium that you pay doesn't change regardless of where you think the markets are going to go. This is telling you whether what you're paying for it right now has a good risk to reward ratio. That's why the options play score does not change. How do you protect yourself when you sell a 1-month call and the market falls while your call is active? Nothing, I imagine. Well, if you sold a 1 month call and the market falls, then your call is profitable and it'll be worthless. And that's a good scenario. So, Joe, I'm not sure. Did you mean buying a call? So let me know if you have a clarification on that. How do you look at the VIX 3M versus VIX? So I use TradingView. You might have a charting package from your broker that provides this, but you just do VIX 3M divided by VIX. And I draw a line at 1 for myself to see when that triggers. That's how I look at it. Where can I find this recording for my review? So we'll send the recording out to you as an email in about 30 minutes after we finish here today. Any trade management advice on options play PayPal strangles strap? James, I unfortunately, that wasn't my trade. That was Michael's trade. I don't know. Oh, it was a double diagonal, right, on PayPal. I don't know. Did it exceed his strike? Yeah, his strike was 130, I think, to the upside, or 135 to the upside. Yeah, so certainly vastly exceeded it. So, I mean, that strategy I don't think is unprofitable. I'll be honest, I'd have to look at that trade. I simply don't have that up, James. On the VIX, there were many pullbacks on the way down. How do you know if you've reached the lowest point? On the VIX, there were many pullbacks on the way down. So usually you want to wait for at least a few trading days, right? So let's look at SPY, compare that to the VIX. So most of the pullbacks did not last more than a single day, right? This VIX, this pullback was just a single trading day. This pullback was a single trading day. This was 5 full days between March 16th and March 23rd. So once you get, I think, 3 days of VIX pulling lower as the markets continue to move lower, that's usually a good sign that things are starting to turn around. General question, is there any advantage to choosing options that expire in the 3rd Friday versus other dates? Generally, from a liquidity perspective, no. I generally tend to find that the monthly options have fewer strikes. So if you look at the June for Microsoft, they are $5 strikes. If you look at the June 12th, which is the weekly options, they are $2.50. Normally they list more strikes. Usually as you get closer to expiration, let's say the June 15th. Also, I don't know what's going on lately, but this is partially, I think, due to the current volatility. They're not listing as many strikes, but usually the weekly options, you get a lot more strikes than the monthly options. There's no advantage or disadvantage to the monthly options. You might sometimes find that the very last listed weekly, so if you go out to June 26th, that the bid-ask spreads are quoted a little wider, but they're not any less liquid. They're just quoted wider. But from a trading perspective, there's no difference. Can you explain how to do an options price calculation based on the stock's potential price? For example, if stock XYZ trading $100 the call option for, how do you calculate how much you're worth if it trades up to 110? Jeffrey, the answer is, if you really want to do the math, then you're going to have to pull out your Black-Scholes formula in order to do that. You're going to have to do quite a bit of math. I don't recommend it. What you're better off is using our P&L simulator, using real options and saying that if the stock goes up 10 bucks, how much money should I expect to profit? Because we have all the math that's being done behind the scenes is giving you the result that you're really looking for. But if you really wanted to do that calculation, you'd have to consider delta and gamma and theta in order to calculate that. Not an easy thing to do because those things it's difficult to isolate. The double screen, is that something you did, or is that offer that the platform gives? I think you're referring to TradingView. You do have to pay extra for the multiple screens here at TradingView. That's kind of how they get you, I'll tell you that. Short-term targets for SPY. Hey, I think 285 is just going to be where this market is going to be pinned here for a while. But again, if you want to learn more about what our views are on the market, please join us on Tuesday and Friday mornings. That's what we are here to do. Sunil's asking, in this environment, how far out would you write your cover calls, short or medium? Very short term. I usually go out about 3 weeks as a starting point for my cover calls. You can go out up to 45 days, generally speaking. So anywhere from 3 weeks to 45 days is a starting point for cover calls. Do you offer one-on-one sessions? So Sheila, unfortunately, that's not something we do at the moment. Chart settings, yes, Thomas, I do think I see your email. I will respond once we're finished here. Vincent is asking, is there a rule of thumb for how much in the money the put to buy should be? So generally, like I said, about 50 to 60 delta is a starting point. I will say that the more I look at this, the more I lean towards closer to being a 50 delta, 55 delta, somewhere in that range. So that's usually how we measure how far in the money. What about using calls on SH, the inverse ETF for SPY? So Rick, this is really, I'm glad you asked that question. You should never use these inverted ETFs for trading more than a single day or trying to hedge your portfolio for a single day. It's the same reason why USO didn't rally when crude oil started to rally. It's because they're trading derivatives. You're basically trading a derivative on a derivative. And what you're going to then pay for is the cost to carry on those derivatives. So SH is only going to provide you with inverse exposure for a single day. If you hold on to SH for a week, it's not going to give you the inverse return of the SPY over a week. It's going to give you less than that. So any type of leverage or inverse ETF, if you look at the prospectus, they're only providing you that type of exposure over that single trading day. It's not meant for long-term exposure. So do not use these for hedging. I can't stress that enough. The VIX 3-month you can use on a platform like TradingView. Also, many trading platforms like Thinkorswim offer it. If you have VIX futures on your platform, you can use that as well. So there's a few different ways that you can get it. Can you please say again about the VIX? It was 1 day and 30 day. No, 1 month and 3 months. So the VIX itself is a 1 month, and then you can also look at the 3-month VIX as well. Baba, earnings next week, trade idea. That's not what we're here to do, Kitan. If you want to look at ideas, please join us tomorrow morning, or that's where we're going to talk about ideas. Qs in your browsers, it says bullish on 6 months. Please explain your exhaustion and hedges. So Qs, I would say, are less exhausted than the other. But as you can see, we have now made 2 higher highs, while momentum continues to move sideways and has failed to confirm those higher highs. That is the same thing that we saw at the beginning of 2020, right? As the markets continue to move higher multiple times, momentum continued to not make any moves higher and actually started to move a little lower. And that preceded the initial sell-off here. So that's the same type of exhaustion that we're seeing right now. That doesn't mean that Qs can't move higher. It just means that the probability of it moving higher is smaller and the probability of a pullback here is significantly higher. What is the options play score? The options play score is the risk to reward ratio of these strategies. So you have red and green, potential reward, and red is potential risk, and then you have a probability of success. So it really thinks about each trade like a poker hand or a finite game where you have winners and losers and a probability of winning and losing. It's just telling you whether the edge is in your favor or against you. Red scores means poor or poor risk reward, yellow means average risk reward, and green means good risk reward. I went to cash on 317, but missed all upside. Was thinking to get back in. Should I continue to wait? I would say that it's a little late to get back in at the moment, because then I think you are at a much higher risk of a pullback here, and you would suffer significantly more losses in your portfolio. I think if anything, you want to start collecting some premium here. If the markets start to roll over, you buy some put options on your portfolio, make some of those gains back, and then when the market has reached another bottom, then you want to reinvest your portfolio. How would you analyze the Visa trade? So again, Daryl, if you want to look at specific symbols, please join us tomorrow morning. That's when we're going to look at strategies together. Do you give trade recommendations on the weekly basis? So we talk every single Tuesday and Friday about where we think the markets are going. So please join us Tuesday and Friday morning. I posted a link into the chat window with how to join us here. How to find which stock symbols have higher volume. I think most basic screeners should be able to show you that, but I'm not sure what higher volume is necessarily going to provide you with, because generally speaking, low price stocks have higher volume than high price stocks. So you're just basically looking at what stocks have lower prices. Can you elaborate on your chart settings that show VIX rollover? Yeah, so it's just VIX 3-month divided by VIX. And you can just look at the VIX versus the VIX 3 months. So you see VIX is 31, VIX 3 months is 34. So the 3-month is above the VIX. So that tells me that we're on a risk on environment. When the VIX 3 month is below the VIX, then we're in a risk off environment. Where can I find credit spreads? Again, you can find our credit spread strategy here on maximizing income with credit vertical spreads on our YouTube channel, which I posted into the chat window. That's a good starting point. Could you explain the VIX inversion again? I think I've explained it quite a few times. Does your platform have some kind of auto scanner for finding good short and long-term risk reward spreads for credit or debit spreads? That is something that we're actually currently working on. We're actually utilizing it in many of our daily play trade ideas. So we're really excited to be launching that soon, but it's not quite ready for publication just yet. What's your outlook for interest rates, Wayne? That's something that we discuss on Tuesday mornings and Friday mornings. So please join us tomorrow morning. We're going to discuss some of those things. For SPY, options play score is much better on the bearish trade than bullish trade. Does that mean we should focus on debit put spreads? Sonny, the only thing that the options play score tells you is the fact that puts are relatively cheap right now, but that doesn't mean anything in terms of where the markets are going to go. That just tells you puts are cheap. What do you mean when you said the front and later month VIX inverts? So VIX, if you look at VIX futures expire in different months. So the front month is the one that expires this month, in this case, particular May. And then if you will go out 3 months, going out to the July, and you're comparing the May contracts versus the July contracts, that is a good indication for how to look at VIX inversion. How come some of your daily plays don't have a high option score? Option score is just one aspect of your trading. You can't just have a single indicator that everything lives and dies by. The options play score is something that we heavily look at. I will say that very rarely do we put out a trade with a low options play score. If you have one that you can remember off the top of your head, but we really utilize the options play score heavily in our trading. The other thing that we also use, more importantly, is direction. Direction is far more important than anything else. You can have the cheapest option in the world, but if you get the direction incorrect, you're still going to lose money. And vice versa, you can have the most expensive option in the world that you sell, but if you get the direction correct, you're still going to lose money. So options play score is only telling us if we have a slight edge in terms of being an option being cheap or expensive, but that doesn't make or break a trade. What makes or break a trade is your directional view. So that's our first and foremost, and the options play score doesn't tell us anything about our directional view. Why sell a credit spread rather than selling a call? So selling a naked call has a lot of risk, right? So if the markets do continue to move higher, you are taking on an unlimited risk. Most people don't have the margin to sell naked calls. That's why we sell credit spreads. I've been using SH strangles with closed expiration. I should push out to about a month or less. I think this is a question about SH. Again, I hope that my previous answer about SH makes you reconsider using SH. You're better off buying puts on SPYs than calls on SH, because again, SH is an inverted, it's a derivative on a derivative, and you're paying that extra carry cost. So you're trading a derivative. You're just adding more layers of complexity to it, and it's going to cause underperformance of the strategy than if you just bought puts on SPY. With the Fed pumping unlimited liquidity, what will drive the markets lower? Well, you could say the same thing. Well, that's a good question. I don't know. I'm not saying that the markets are going are going to necessarily be driven lower. I'm just saying that you have a higher probability of that happening. But the Fed was also pumping liquidity into the markets back in January and February. COVID-19 is what caused the sell-off. I don't know what's going to cause another sell-off. Maybe a second wave of coronavirus and we shut down states again. Maybe that's what causes it. I don't know. I'm not here to speculate on that. But I do know that if and when that happens, I'm prepared in my portfolio. And in the meantime, I'm collecting premium when I don't think the markets have much more steam to go ahead, move higher. Are there options on Bitcoin? Not that I'm aware of that retail traders can trade. Would you trade options on $2 to $3 shares on biotechs, or would you prefer larger? I don't prefer, betting on any individual biotech names. I prefer the index itself. If you look at IBB, that's one I've been talking about a lot during our Tuesday and Friday morning sessions. Above 123, I still like IBB. I like betting on the whole sector. Can you discuss using options on VIX? I'll be honest, I don't trade VIX. I don't like trading VIX because the VIX, VIX is a calculation. It's not an asset. So that's why I don't like to trade something that's just a calculated value. How long would you have bought your put options? And how long would you have bought your put options? 2 to 3 weeks. I'm not sure if that's a question. If you don't mind clarifying, Nor. What should you do if you sell a cover call and the stock price then was much higher than the strike price in the weeks before expiration? You should wait until you get closer to expiration. If you're still above the strike price and you want to hold on to the stock, you buy back the call. Otherwise, you let the stock get called away, take your profits, take the cash and move on to the next stock trade. If you're wrong on your timing, the comprehensive would have much greater drain on the long term, on the total return of your portfolio. That's exactly why I'm telling you, don't buy puts when markets are calm. Don't buy puts now. Buy puts when things are starting to turn around. When the VIX contango, when the 3-month VIX jumps above that 1-month VIX, when 1-month VIX jumps above 3-month VIX, that's the only time to pull the trigger. The market has not been wrong many times when that triggers. And if it is wrong, it flips back very, very quickly, and you would not have lost much money on your comprehensive put options in that particular case. You mentioned the deceleration in money flow that's been pushing the markets to higher levels. When do you start seeing a pullback? Again, I'm not here to try to predict that pullback. I have no idea when that pullback is going to happen. I don't think anyone does, but that's my point, is wait until you get the signal and the markets start to move lower before you buy those puts. Is it worth putting an option trade on a $2 biotech? Giovanni, it's just, I don't know what biotech you're talking about. So I think it depends on the company. What days to expiration vertical credit spreads do you sell? Usually anywhere between 3 weeks to about 3 to 5 weeks out is usually a starting point for selling a credit spread. Why 3-month versus 1-month VIX? Because that measures the stress of the market. When the 1-month VIX is trading at a higher volatility than 3-month VIX, that's telling you that we expect that the short term of volatility is significantly higher than what we expect 3 months out. Can options be pumped and dumped with signal providers? In theory, I guess with a very small cap stock, but an option is just a derivative on the underlying stock. So in theory you can, but you'd have to trade tens of thousands of contracts to do that. Could you please go through a Schwab call credit spread trade? So the Schwab call credit spread trade, I'll go through that real quick. I'm certainly coming up on an hour and a half here, so I don't want to spend too much more time. But the call credit spread that we sold on Schwab was the 35.38, I believe it was. And we sold it for, I think, $1.25 or $1.30. It looks like it's trading at $1.30 right now. Yeah, we sold it for $1.30. It's still trading at $1.30, so it's flat. It hasn't moved at all. My earlier question has to do with worrying about the market falling. I don't want to have calls that I've sold active at the time. That is, I could sell a cover call on Apple, say 300, the market falls, Apple's worth 200. Joe, I'm still not sure I understand your question, because if you sold calls on when it was at 300, the market falls, then you've made money on the call options. You would buy back the calls, and you could choose to decide what you want to do with the stock. Do you want to hang on to it? Do you want to sell it? It's completely up to you. But the calls did exactly what you wanted, which is collect the income that you selected. Okay, so I really tried to cover as many questions as I can, but unfortunately there were just too many, but I tried to get through as many as I can. I really appreciate everyone taking the time out here this afternoon. So many of you have stayed on, the full hour and a half. Thank you so much. I really appreciate that you guys join me every single Thursday, participating, asking questions. Again, I hope that this is useful for you guys to better understand how to position yourself in this very challenging market to trade, because it's hard to say where do you think markets are going to go. But in this particular market environment, when things are starting to show signs of exhaustion, when most of us are saying that we don't know where the markets are going to go, or some of us think the markets are going to move lower, now is the time to collect premium and wait for that signal to buy put options if and when the markets start to correct. Might be next week, might be next month, but when it does happen, you're prepared. So I will be sending out the recording to everyone here in a few minutes once we wrap up here. And I hope to see most of you tomorrow morning at 9 a.m. bright and early. We're going to talk about what research we're looking at, what symbols we were paying attention to, what sectors. We look at that on Tuesday. Tomorrow, we'll take a look at a little bit more longer term, some of the themes that we see post COVID-19. So thank you so much, and I hope you guys have a great evening.